Corporate finance practice problem using Excel. Bond refinancing decision problem number 2. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab in essence being the answer key. Information on the left-hand side, we're going to populate that into the blue area on the right-hand side, calculating the bond refunding decision. Information. Bond obligation that's currently out, the $40 million, the issue rate 13%, current rate 12%. It being lower is the thing that's going to spark our decision-making process to see if we want to do the refunding. Originally issued years ago, 8 years ago, years remaining 18. In other words, it was originally issued for 26 years, 8 years ago, years remaining 18 of the original issue of the 40 million. So the new issue years are going to be 18. In other words, if we retire the other ones and we reissue the current ones, we're going to issue them for the same time period as the years remaining, that being 18. The call premium on the old issue is a little bit more complicated now. It's going to be the 5%. We're going to say that we couldn't do that until after year 6. And then there's an added decrease of 0.5% for each year after year 6. It's currently year 8. So we're thinking it's going to be 5%, and then 5%, and then it's going to go down by 0.5% times 2. So we'll have to take a look at that shortly. And then we have the underwriting costs on the new issues are a percent of the bond value. So the bond value is the 40 million, so we'll have to take that percent of the bond value. Underwriting costs on the old issue was a percent of the bond value, same calculation, times the 2.7%. And then the tax bracket, 35%, the discount rate at the 11%. So we're going to calculate first the net cost of the call premium. Net cost of the call premium. So to call these things, we're going to say the bond obligation was the 40 million, and multiply that times the call. So the call amount, call premium, and that's going to be the little bit of a twist here. That's going to be the 5%, but then it's going to go down minus by the 0.5% times the number of years after 6 years, which is 2. So we're going to say times 2, making that a percent. Number group, making that a percent, 4%. Font group and underline. So there we have that, and that's going to give us our cost before taxes. And put that in the outer column. This is going to be the 40 million times the 4%. Let's indent those ones by going to the alignment group, indent. I'll indent this one again, alignment, and indent that again. Then let's take a look at the tax impact percent. And I'll calculate this out one time, and then we won't do this detail. It's going to be 1 minus the tax rate. So the tax rate is going to be equal to, we're in the tax bracket, we said, of the 35%. We're going to be picking up the last tax bracket most likely because we're making this decision on the margin. So if it's a progressive tax system, we might be using the last tax bracket. That's going to give us our tax impact percent. Let's indent these two, alignment, indent this one, alignment, indent, multiply this out, or not multiply, subtract this out. 1 minus the 35%, making that a percent, number group, percentifying it. Underline it, font group and underline. That's going to give us our net cost of call premium. And this is going to be equal to the 1,000,006 times that 65%. There we have the 1,040,000. Then let's take a look at the underwriting costs and the tax impact. So the underwriting costs of the new issue, we're going to calculate that to be the 40 million times, and we said underwriting costs of the new issue, the 3.5, that's going to give us our 1,400,000, 1,004,000, and then we're going to issue. So that's the cash that we assume will be going out. We're actually paying that out now, but there's going to be a tax impact. For taxes, we're going to assume we can't take the deduction all now, but have to allocate it over the life of the bonds, in this case, 18 years. So issue years, we're going to say are 18 for the life. And therefore, if I underline that, font group and underline it, we got the 1,004,000 divided by the 18 gives us the 77,778 about That's going to be basically an expense per year that we're looking at. Now we're going to take the tax rate, to see the tax impact, which will be equal to the 35% down here on the tax rate, making that a percent, numbers group, percentifying it, font group, and underlining it. So we take the 77,778 times that amount, the 35%, 27,222 is basically the tax impact per year. Let's call it per year. Tax impact per year. So quick recap, we're paying the $1 million for, but we have this tax benefit. We have to spread out the expense, which will be the 77,778 that we'll have to take per year for 18 years to finally get the benefit of the deduction of the $1 million for, and the tax benefit on that on a yearly basis is the 27,222. So now we want to present value that 27,222 so we can consider it in our decision-making process. So we're going to take the present value of the tax savings, let's call it that. This will be negative present value, shift 9. The rate is going to be our 11% discount rate, comma. Number of periods will be 18, comma. And then we've got that payment amount, the 27,222. That gives us the 209,655. So that's going to be our benefit. And then we can sum this thing up down below. The present value of the cash outflows is the net cost of the call premium. So net cost of the call premium, which is the 1,040,000. And then we've got the underwriting costs, which we're going to make 1,400,000. And then we've got the benefit of the present value, the tax savings are going to make that a negative. So we could just sum this up with the trusty sum function, underline that. That'll give us our present value of cash outflows. Summing that up equals the SUM. Summing that up, we get then the 2,233,44. So now, let's go back up top. We're looking at the net annual interest savings now. So we're going to take the difference between the interest rates. So we have the initial, let's call it the initial rate, and let's say interest rate, and then the current interest rate. So we'll take the difference between the two of them because we're looking at a differential type of calculation. So we had the prior rate was the 13. The current rate is going to be the 12. We're going to make these three cells a percent by going to the number group, percentifying it, underline this cell, font group, and underline. And then I'm going to say this is the difference, which will be equal to the 13 minus the 12. So we got the difference of that 1%. We're going to take that times the bond, the face amount of the bond. This is going to be the bond, and that's going to be equal to the 40. So the differential calculation then being 1 times the 40 million, underlining that, and we're going to call that the net annual interest savings before taxes, this being the 1% times that 40,400,000. The tax rate then is going to be, or let's say tax impact percent, let's call it, which will be equal to 1 minus the rate, which is 35%. That gives us, if we make that into a percent, number group, percentifying it, 65%, underlining that, font group and underline, we get the net interest savings. And that's going to be equal to the 400,000 times the 65%, we get the 260,000. 260,000. Now that's going to be the savings yearly. So once again, we have this for 18 years now that this is going to happen. So we need to do our present value calculation to take that annuity so that we can do our comparison as of now. So this is going to be negative present value, shift 9. The rate is going to be our discount rate on the left, the 11%, comma, and then we've got the number of periods. The number of periods is going to be 18. Let's pull that over here. Let's pick up the 18 and 18, and then comma. And then we have the payment, which is going to be that amount. We just calculate the net interest savings, the 260,000. That gives us our 2,002,420. So there's going to be our present value of the interest savings. Then we're going to do the annual amortization of the old issuance. So now we're going to think about the old issuance, the cost related to it. And so that's going to be equal to, we have to do this little calculation again, which was the 40 million times the underwriting cost of the old issuance, which was 2.7% of the bond face price value, 1,080,000. And so this one, note, we already paid it. So we're not really talking about the payment that's going out right now. We're going to assume we paid that when the old issuance took place. But we have this situation where there's going to be a tax impact because remember, we had to amortize the cost over the life. That's what our general rule is for taxes. Now, what's happening now is if we decide to remove the bonds, then retire them, then we should get the rest of the unamortized cost and get the tax benefit of it today, versus if we decide not to, then we get to keep on amortizing the cost. So there's a difference between the two decision-making processes due to the time value of money. So let's take a look at that. We're going to say this is going to be equal to, we'll say then the 8 plus the 18. That's what they were originally issued for. So 26 years. So if they were issued for 26 years, we would say the cost per year that was expensed, right? We would expense every year, dividing this out, the 41,538. That's how much we would expense each year. And there's only 18 years remaining, so we're going to say years left, or remaining are 18. Let's say this equals the 18 over here. And so that means that the unamortized portion, if we're using just a straight line kind of method here, so the unamortized cost, let's call it, that we would still have a tax benefit for, which would be the 41,538 times the 18. So we already have the cash flow of the 1,080,000, but we didn't get the tax benefit yet for all of it because we had to allocate it over the full life, 26 years, of which there's 18 remaining. So that means we have the 747,692. If we decide to retire the bonds now, we basically get the full benefit of that, you would think, because we're assuming then we get to take the costs of the unamortized portion at now since we're retiring the bonds. Otherwise, we would have to keep on amortizing them over the 18 years. So we're looking for that differential between the two decisions. So if we decide to retire them, then we get the full amount now. If we don't, we have to take it in the form of 41,538 for the next 18 years. Same total dollar amount, but due to the time value of money, there's a difference in the value. So we have to do our present value calculation, negative present value, shift 9. The rate is going to be the 11% over here, comma, and then the number of periods is 18, comma, and then the payment is going to be that amount that we just took a look at. And that will then give us, hold on, that's not right. The payment's not right. The last portion isn't right. The payment is going to be the cost per year, or the 41,538, the 41,538, and then enter. And so there's going to be our 319,913. Okay, so let's calculate our difference down here. So the unamortized cost is the 747,692. The present value of the unamortized cost is the 319,913. Underlining that font group and underline, we're going to say this is going to equal this 747 and so on minus the 319 and so on, giving us the 427,779. That's going to be basically the gain. We'll call it the gain on unamortized cost, the gain on unamortized cost. And then we'll apply our tax rate to that. Tax rate, which is going to be equal to the 35%, making that a percent, numbers group, percentifying it, font group, and underline. And that's going to give us our cost tax savings, which will be equal to that 427,779 times the 35%. And so there we have the 149,723. So if we kind of sum up the cash inflows, then we've got the present value of the interest savings, which is going to be equal to, we're going to pick up the 2002420 up top. And then we got the cost, tax savings that we just calculated, which is going to be equal to the 149,723. And then we've got the present value of the cash inflows. That's going to give us the present value of cash inflows, which is the sum of those two. And let's put an underline here, font group and underline. So now we can kind of sum this thing up. Let's go back up top to do so. So we'll go back up top here. And we'll have our net present value. This is going to be equal to, we'll take a look at the outflow here, present value of the outflow. I'm going to make that negative. So I'll call this a negative of the outflow. Negative of the outflow. And there we have that. And then we'll take the present value of the inflows that we just calculated here. Present value of the inflows, making that a positive present value of the inflow. And let's put an underline there by going to the font group and underline. That's going to give us our net present value. And summing that up equals the SUM. And that gives us our 78,202. Now this is a negative, so given our normal kind of present value things, it would not be, we would say, nah, not going to do that because it's not clearing our discount rate.